Canadian housing market crash. What goes up comes down. This is your November 2020 Canadian housing market update. Hey, what's up, guys? Welcome back to DG Capital. This is your premier destination for personal finance, investing, and real estate. Have you been scratching your head trying to figure out why Canada's housing prices are continuing to skyrocket? Even though a global health pandemic is seemingly closing businesses almost every day, you're not alone having these thoughts. Many people have been scratching their heads trying to figure out what's happened with Canada's housing prices. Why have Canada's housing prices jumped 17% in the middle of the worst economic crisis to hit the world in decades? When you really think about it, it just seems so senseless. So, let's break it down. There was an interesting article in the Huffington Post recently that looked into this. So let me summarize the article and give you my 2 cents. The article goes on to say that in order to answer this question, why Canada's housing prices are still skyrocketing, we have to look at the monetary policy that the Bank of Canada has used to create this grand illusion. The illusion of a healthy economy is nothing but smoke and mirrors created by the central bank's money printing and government's reckless spending. So if it looks like housing prices are out of control and they have lost their footing from reality, it's because the prices we are seeing today can no longer be tied to reality. Do you remember when CMHC prepared that housing forecast that prices in Canada's housing market will decline by 9 to 18%? Man, did they get into trouble for making that irresponsible prediction. Many members of the real estate industry were upset at the head of CMHC for making such a reckless prediction. Considering rising home prices are in their favor, I get it. I get why they'd be upset. So how did CMHC, essentially a government body, get it so wrong? According to the article, CMHC's big mistake was approaching the housing market as if it's tied to some sort of reality. The reality of the people in the housing market. They were looking at unemployment rates, household debt levels, wage levels, mortgage rates. You know, the basic ingredients in a recipe, if your recipe is called house price changes. In a healthy, normal functioning economy, they would be correct looking at those factors. However, for our Canadian economy, we tend to function on a different level. The Bank of Canada started a program of quantitative easing shortly after the outbreak of COVID-19 forced many out of jobs and many businesses to close. Quantitative easing, in simple words, is a monetary policy whereby a central bank buys government bonds or other financial assets to inject money into the economy in order to expand economic activity. By taking this approach, the Bank of Canada pushed down interest rates, making it easy for the federal government to run a deficit spending program that gave out free money. Now, this program, it was necessary because countless Canadians needed that cash injection in order to help pay their bills without some sort of income coming in from employment. I get that 100%. Problem is, Canadian households received more than $56 billion from government aid programs like CERB and other transfers to replace those lost salaries and wages, which, by the way, amounted to, get this, $23 billion. Do you see a problem with this math and where the story is going? On net, household disposable income spiked 11% in Canada. This substantially increased home buyers' purchasing power. On the flip side, forecasters, not named CMHC, who saw higher prices, knew cheaper mortgages were on the way. And they also remembered a simple lesson from the US Federal Reserve's money printing operation a decade ago. During the Great Recession, the rich got richer. There was a massive run-up in equity prices, stocks, bonds, and real estate that largely benefited those who own stocks, bonds, and real estate. Money became cheap as the central bank continued its money printing operation. In the middle of our pandemic-related economic crisis, stocks are soaring, housing is soaring. Meanwhile, lower income earners working in the services sectors and a lot of blue-collar jobs were the hardest hit. According to CMHC's own published data, the agency bought $5 billion worth of mortgages in its first round of operations back in April. It bought $806 million in the second round and $10 million in the third round back in May. It's not a secret that the Bank of Canada and the government will not allow the housing market to tank. When there's that much free money flowing into the system, those homeowners who have seen their home equities skyrocket will trade their homes for larger homes, creating even more demand for single-family homes. All this just makes it that much harder for first-time home buyers to get into the market. The article goes on to conclude, maybe reality will make an ugly comeback. In the meantime, our stock market and house price reports will continue to look like we live in the best of times. The article makes some great points, and I truly believe that the housing prices in Canada are insanely high and showing no signs of returning to normal, whatever that may be. But sometimes we forget Canada is a big country, and not every city is equal. Sure, when you look at the GTA, Ottawa, Windsor, Vancouver, it's easy to say that the housing market is out of control. But what's happening in other cities? Calgary is going against the trend among major Canadian cities that real estate prices is cheaper today than 5 years ago. This is a stark contrast between Canada's energy capital and other top urban centers. Since oil prices fell back in 2014, so have home prices. They've also gradually come down. The benchmark price for a single-family home in Calgary fell 6% over the last 5 years. That's down $30,800 to a price now of $466,000. And this makes Calgary the sixth least costly market among all urban centers. Condos in Calgary are experiencing an even steeper decline in price. The benchmark price for a condo is now less than $250,000, which is a drop of 14% in the last 5 years. Almost hard to remember, there was a time when everyone wanted to move to Calgary because of the oil boom the province experienced for so long. People forget that housing cycles and market cycles, they come and go. There come periods of prosperity, but also corrections. Problem is, when you're in a prosperity for so long, it just seems like that the good times will just keep on rolling forever. The national price for a single-family home in comparison to Calgary grew by 40% in the last 5 years to over $683,000. Meanwhile, the benchmark price for a condo grew by 52% to over $478,000. In the last 5 years, when we look at Greater Vancouver as an example, condos are up 63%, while single-family homes are up 28%. Turning to the Greater Toronto Area, prices for condos are up 78% and up 51% for single-family homes. Speaking of condos, it may seem like the market is turning the corner on this segment of the housing market. RBC Economics reported on October 15th that condo prices have stagnated over the last 6 months. And what's more, condo owners are looking to sell, leaving the market overflowing with condo supply. As rents get cheaper due to higher vacancies, condo listings will continue to rise in the big cities of Toronto, Vancouver, and Montreal. Toronto's pandemic condo buyers are doing significantly worse at this point. The price for a typical condo has fallen 2% since April, or about $11,000. Assuming a 5% down payment, and when you factor in insurance, this works out to a negative return on equity. Let's look at some stats. In September 2020, condo listings were up almost 134% for the city of Toronto compared to the same time last year. For the rest of the GTA, condo listings were up over 81% in September 2020 on a year-over-year basis. In Montreal, condo listings were up over 41% in September 2020, year over year. In Greater Vancouver, condo listings were up close to 21% in September 2020 on a year over year basis. Rural and suburban markets continue to be hot outside of these major metropolitan areas, as home buyers are trading in their condos for single-family homes, as COVID-19 restrictions are leaving buyers looking for larger living spaces. Affordability issues are also driving Canadians away from large urban centers into smaller towns and cottage country where there's still larger living spaces available. September 2020 set another record for Canada's housing market, with home sales up close to 1% higher over August 2020, which itself was a record-breaking month. However, newly listed homes fell back 10.2% in September. The national average selling price, including all unit types, has now crossed over $600,000 for the first time in history, coming in at over $604,000. The national average selling price will be closer to $479,000, if not for the GTA and Greater Vancouver. When looking at year-over-year gains as at September 2020 across the country, there were 26 regions out of 37 which experienced at least 10% year-over-year growth in pricing, 18 of which had gains of at least 15%. Only one region experienced a year-over-year decline, and that's Calgary. City of Ottawa experienced a 22% year-over-year price increase in the region. Cities like Barrie, Hamilton, Niagara experienced gains of between 15 and 20% year-over-year. Oakville, Mississauga, Milton were in the 10 to 15% year-over-year bracket. Greater Vancouver and Saskatoon are up around 5% year-over-year. Meanwhile, Edmonton's price change year-over-year was flat. What we're seeing in Calgary and in the condo markets of big cities like Toronto and Vancouver, this could be signs of cracks starting to show in Canada's famous housing market. I know I'll be keeping a close eye on how this story unfolds. And that's it for this video. Thank you so much for watching. Make sure you hit that like and subscribe button so you're always in the know of what's happening in Canada's housing market. Let me know what your thoughts are about the stats presented in this video in the comment section below. And I'll catch you guys in the next one.